Imagine walking into your local grocery store and noticing that everything costs more than it did last month. Your coffee, your bread, your steak, and even your favorite snacks. How do economists track these price changes across millions of products for hundreds of millions of people? The answer is Consumer Price Index, popularly known as CPI. And understanding it could completely change how you view the economy and how you invest your money. By the end of this video, you'll understand exactly what CPI is, why it moves the financial markets, and how you can use this information to make smarter financial decisions. If you're new here, welcome to the channel. My name is Japheth and I simplify stocks, passive income, and long-term wealth without Wall Street noise. This channel is all about one thing: building freedom through smart investing. If that sounds like your vibe, subscribe and stick around. Let's jump right in. So what exactly is the Consumer Price Index? Think of it this way. Imagine you have a shopping basket filled with everything a typical American household buys in a month. We are talking about groceries, gasoline, rent, healthcare, clothing, electronics, entertainment, and so much more. Now, the CPI measures how the total cost of this same basket changes over time. It's called the fixed basket because we are tracking the same items month after month to see if they're getting more or less expensive. When CPI is rising, it means consumer prices are increasing. When it falls, consumer prices are generally decreasing. It's that simple on the surface, but implications run deeper. The Bureau of Labor Statistics collects data on approximately 80,000 items each month. That's from about 23,000 retail and service establishments across 75 urban areas. This massive data collections efforts gives us one of the most comprehensive picture of price changes in the American economy. So what exactly is Consumer Price Index? Think of it this way. Imagine you have a shopping basket filled with everything a typical American household buys in a month. We're talking about groceries, gasoline, rent, healthcare, clothing, electronics, and so much more. The CPI measures how the total cost of this same basket changes over time. It's called the fixed basket because we are tracking the same items month after month to see if they're getting more or less expensive. When CPI is rising, it means consumer prices are increasing. When it falls, it means prices are generally decreasing. It's that simple on the surface, but implications run deep. The Bureau of Labor and Statistics collects price data on approximately 80,000 items each month. That's from about 23,000 retail and service establishments across 75 urban areas. This massive data collection effort gives us one of the most comprehensive picture of price changes in the American economy. Here's something important. The CPI is released monthly at exactly 8:30 a.m. Eastern Time. This timing isn't random. The market normally opens at 9:30 a.m., giving traders exactly 1 hour to digest the data before they can act on it. Now, you might be wondering, why is this number such a big deal? Why do financial networks dedicate an entire segment to it? The answer comes down to one word: inflation. CPI is the primary tool we use to measure inflation, which is the rate at which the general level of prices for goods and services is rising. And inflation matters because it directly affects your purchasing power. If inflation is 5% and you get a 3% raise at work, you're actually losing purchasing power. You can buy less this year than you could last year. But it goes deeper. The Federal Reserve, the America's central bank, pays extreme attention to the CPI because it's mandated by Congress to maintain price stability. The Federal Open Market Committee, known as FOMC, targets an inflation rate of approximately 2% per year. Why 2%? It's a sweet spot. It's high enough to avoid deflation, which can be economically dangerous, but low enough that it doesn't erode purchasing power too quickly. The Fed believes 2% inflation is consistent with maximum employment and price stability. And here is how it works. When the CPI shows inflation consistently above 2%, the Fed typically raises interest rates. Higher interest rates make borrowing more expensive, which slows down spending and investments, which eventually cools down price increases. Conversely, when CPI shows inflation well below 2% or worse deflation, the Fed may cut interest rates to stimulate borrowing, spending, and investment, which helps boost prices back towards the target. When the monthly CPI report drops at 8:30 a.m. Eastern Time, you can literally watch markets react in real time. Billions of dollars shipped within seconds. Why? Because changes in the CPI signal potential changes in the Fed policy, and the Fed policy affects everything. Always remember, don't fight the Fed. Now let's break down how different markets react to the CPI data. When the CPI comes in higher than expected, showing elevated inflation, markets often anticipate the Fed will raise interest rates. Higher interest rates make bonds more attractive compared to stocks, and they increase borrowing costs for companies, potentially adding their profits. So stocks, especially growth stocks in indexes like Nasdaq 100, often sell off. But when CPI comes in lower than expected, suggesting inflation is cooling, stocks often rally because traders anticipate the Fed will either keep rates steady or potentially cut them, which is positive for corporate earnings. Number 2, we have bonds. Bond markets react inversely. When inflation rises, bond prices fall and yield rises. Why? Because inflation erodes the purchasing power of the fixed payments bonds provide. Investors demand higher yields to compensate for this inflation risk. Number 3, the US dollar. The dollar normally typically strengthens when CPI shows higher inflation because traders anticipate the Fed rate hikes will attract foreign investments seeking higher returns. But if CPI shows inflation is cooling, the dollar may weaken as the rate hike expectation diminish. Number 4, commodities. Gold often moves up with inflation expectation as investors seek inflation edges. Oil and other commodities are both influenced by contributors of inflation, creating complex relationships. Let me give you a real-world example of how to read and react to CPI data. There are generally 2 ways professional traders analyze CPI data. First, they compare the actual release to market forecast and the previous month's reading. Second, they compare it to Fed's 2% target. Let's walk through a scenario. Imagine it's tomorrow morning and the US CPI report is about to be released. Last month's year-over-year inflation rate was at 8%. Analysts surveyed by Bloomberg expect it to decline to 7.5%. At 8:30 a.m. Eastern Time, the report drops. The actual number is 7%. What happens next? This is a bigger decline than expected. It beats the market forecast of 7.5%. Here's how traders might interpret this. Inflation is cooling faster than anticipated. The Fed is less likely to aggressively raise rates. This could be positive for economic growth. Results, traders might long the Nasdaq 100 index, betting on tech and growth stocks that benefit from lower rate expectations. You might see the Nasdaq jump 2% or 3% within hours. Meanwhile, the US dollar weakens against other currencies because lower inflation expectations reduce the likelihood of the Fed rate hikes, making dollar-denominated assets less attractive to foreign investors. Now, here is something crucial that often confuses people. You'll actually see 2 CPI numbers on each monthly report. The CPIW, the Consumer Price Index for all urban consumers. This number represents 93% of US population living in urban and suburban areas. This is the number you'll see in the headlines and the one financial markets react to most strongly. CPIW, the Consumer Price Index for urban wage earners and clerical workers. It's used primarily for adjusting Social Security benefits. Remember, the Bureau of Labor Statistics releases the CPI report once per month. You can find the exact schedule on the past and upcoming releases on the BLS website. Many traders, including myself, will mark these dates on their calendars because we know very well the market will be volatile. Before we wrap up, let's go one level deeper. Professional economists and traders don't just look at the headline CPI number. They also examine what's called Core CPI. Core CPI excludes food and energy prices. Why? Because these categories are extremely volatile and can swing wildly month to month due to factors like weather, geopolitical events, or even seasonal demand. Core CPI gives us a clear picture of the underlying inflation trends. You might see a month where headline CPI spikes due to sudden increases in oil prices, but the core CPI remains stable. This tells the Fed and the traders that inflation may be temporary rather than systemic. The CPI basket is also divided in major categories with different weights. Now, housing accounts for about 33% of CPI, transportation about 16%, medical care about 9%, and several other categories. Housing has the biggest weight, which is why changes in rent and home prices have such a significant impact on overall inflation. One final point: the concepts are similar, but methodologies can vary. The European Central Bank, for example, targets inflation using the Harmonized Index of Consumer Prices, or HICP. So let's recap what we've learned today. The CPI measures changes in the average price of level of fixed baskets of consumer goods and services. It's the primary measure of inflation in the United States. The Federal Reserve uses CPI to guide monetary policy, targeting around 2% inflation. The CPI report is released at 8:30 a.m. Eastern Time once per month and can cause significant market volatility. Higher than expected CPI often leads to stock market weakness and the dollar strength. Lower than expected CPI often leads to market rallies and the dollar weakens. CPIU is the most widely watched version, representing 93% of US population. And the core CPI, which excludes food and energy, gives insight into the underlying inflation trends. Understanding CPI gives you a powerful lens through which to view economic policy, market movements, and even your personal financial decisions. So next time you hear that CPI is being released, you know exactly why traders are watching so closely and what the numbers really mean. If you found this video helpful, please hit that subscribe button and turn on the notification bell so you don't miss our next deep dive into the economic indicators. Drop a comment below. Let me know, have you ever changed your investment strategies based on CPI report? Thanks for watching, and I will see you in the next video.